Okay, guys. So the decision related to the value proposition, like those are more like marketing decisions, right? Are related to price, to the administrative and selling budget, research and development budget. This is not going to be like a decision. I will explain it later, and payment there. Okay. So let's remember that price. If you guys charge a very high price for A, you guys are not going to sell any unit because customer A is really sensitive with this relationship, price elasticity demand. Okay. B is less sensitive. Yes. However, if you are going to increase too much the price for B, like you are going to lose many quantities, but less than for product A. And it works in the other way. If you decrease the price, you are going to expect a higher things. Customer B really likes administrative and selling expenses. Yes. Probably this is because when you invest more here, you can get a better service to the same. R&D, more important for A. This is a product that is in the growing phase of the marketing life cycle. So like customer desire some degree of innovation. Okay. And finally, payment term. This customer A likes that you guys give him credits. Okay, that you are not going to collect the money of the unit that you are selling immediately. Only he expects that you give him 30 days or 60 days. Okay, so this customer doesn't care too much about if you give him more credit or not. Okay, so in the simulator, you guys can go to the decision tab, and in the decision tab, you are going to have like 3 levels of decision. Decisions at the corporate level, and decisions for product B and for product A. Yes, decisions for product A and for product B are exactly the same one. Okay. So those decisions that you guys were looking at are related with the value proposition. Okay. So you have one column that says current. Yes. Those are the actual people. Yes? You guys are the new managers of those companies, and the companies already exist. So you are arriving at some moment, which is the period number 5. Okay. So the previous administration has run the other periods, but you guys are in equal conditions. No? This information that you are seeing here for the yellow team, it is the same for the rest of the colors. Okay. So first column, current price. The other column, the one that has the boxes, says next. So this is the round that you are going to begin to play. Okay. And then you have a third column, which is changes. Okay. This column is going to calculate automatically. Yes. Like the change of the previous round with the one that you are preparing. Okay. So like the simulation like brings the information that was in the previous period, no? So the price for product A for all the companies was $50 per unit. So if you are going to validate the decision right now, it's going to take the information about the previous round. Yes? But for example, you guys are thinking, no, I would like probably to increase a little bit this price, no? A little bit because the elasticity
price demand is important. Yes. So for example, you guys are going to increase the price from 40 to 42. So the simulator is calculating this. Yes, if you move the price from 40 to 42, this is a 5% increase in the price. Okay. The next input is the one with customer payment terms. Okay? You guys are seeing that the company is collecting the money when one product A is sold 60 days later. No? Remember that this customer likes credit. Okay. So you need to take decision. Should I give him more days? Should I give him less days? Remember that. What is the trade-off? No? The trade-off is that if you give him more credit, probably the customer is going to buy you more. But you are like deteriorating your cash flow, no? Because you are not collecting the money as soon as possible. So you can probably decrease the number of days, you are improving the cash flow, but probably you are not going to solve the same amount of units. No? So you need to look for the balance, and you need to understand what is your probably your necessity. Okay? And those two are the budgets that are related to administrative and selling expenses and research and development expenses. Okay. The budget that you guys invest in research and development expense is this one, that is with $115. It is not only important in order for the value proposition, but it's going to impact many other processes of the company. For example, when I'm going to show you the slide. So this rule says that when you invest in research and development, you are like targeting two objectives. One, the product attractiveness to customer. Yes, for that reason we saw research and development in the customer profile slide. Okay, and the other objective is to decrease the manufacturing cost. Design to cost and design for manufacturability. So once you invest money here, you are like trying to satisfy customer, but improving your factory. Okay, you are going to reduce cost, and you have two types of impacts. You have an immediate effect and a cumulative effect. Okay. What is the effect immediate? That you put money there, and this is going to be reflected for the round that you are playing. Okay. But the other point is that if you are going to invest money in a constant like manner, there is going to be like another effect that is going to be cumulative. So if this round you invest a lot of money there, but in the next one you are not going to invest money there, you are going like to blow that cumulative effect. Okay, so take that into consideration. Okay, so this is the information related to the value proposition. Okay, so you can like try to think what you guys are going to do, and okay. For example, if I put $150, this is going to be a 30% increase against the period or the current results. Okay. Let's talk about facility investment. Okay. For facility investment, you guys have two factories. Yes, you have one one company, yes, I'm explaining to the yellow company, and you have two factories, A and B. If you guys want to increase the size of factory A, this is going to cost you $25 per unit. So if you guys put $25 today, this is going to be reflected in the next round that you guys are going to be able to produce one more unit. And for product B, it is more expensive, no? If you want to increase one unit in the next round, you need to make the investment of $100. There's a relation, yes, like 4-to-1, more or less. Okay? No, 4-to-1 exactly. Okay. What is important to understand that you guys have one initial capacity, but you guys are going to need to use less because two reasons. One is the depreciation effect. Yes, like if you guys do not continue to invest, the size of the factory is going to be reduced by the use of the equipment. And the other point is that you have like products that are going to have some problems of quality, and you guys are not going to be able to solve all the production. Yes. So the problem of quality at the beginning is going to be close to 11%. I will show you where is the information. Okay. The other important rule for manufacturing is that you guys have more opportunities to reduce the cost per unit when you are increasing the volume. This is the concept of economies of scale, but especially for product A. So in this graph, you have here cost per unit, and you have here quantity produced. So look at for A, the slope of the curve really increases more than for B, no? So this means that when you guys are increasing the size of the factory A, you can expect that the production cost is going to be reduced. However, for product B, it is not going to be so evident. Okay. And here we have another message: supplier credit. Okay, I will explain this process of supplier credit. So let's go to the simulator. And in the simulator, you guys have here investment in facility. Okay. So for example, for A, in the current round, they invested, the other administration invested $202. So this means that with that investment, you guys are allowed to increase the manufacturing of A almost in 4 units. Remember that it's a relation of in 8 units. Remember that it's a relation of $25 per unit. So if I am investing $200, I can increase the size of the factory A in 8 units. Okay. And the information about manufacturing and sales, it is here at the top of the simulation decision tab. Here you guys have like white boxes and boxes of your color. Yes. Let's begin with the boxes of the color. Production volume and payment terms to supplier. Production volume, it is the amount of product that I'm going to manufacture. Okay, so let's say that I would like to manufacture 70 units. And I'm going to put here 70. And the simulator is going to put me again 56. Why? Because the size of my factory is only 56. If I want to produce more in the next round, I need to do an investment here in facility investment. Yes, and I strongly recommend that you guys invest a lot of money in those facility investments of A and B. Because if some groups at the beginning are going to invest there a lot of money, the others that are going to be behind is going to be very difficult to catch the leaders. Okay, so since the beginning, you guys need to think that especially the product A is going to grow a lot, no? So take that in mind. The other decision box that has color is payment terms to supplier. It says that actually you are not giving any day, or when you have 0 days, this means that your suppliers deliver the raw material for product A, and immediately you guys are going to pay him. Yes? If you guys put, no, I'm going to improve my cash flow. Yes, I'm going to move this supplier, and I won't pay him immediately. I will pay him 30 days later. This is going to increase my cash flow. However, it's going to have like a trade-off, yeah, which is that the supplier is going to tell me, no, I'm going to charge an extra cost because you guys are paying me later. Okay, so you guys can calculate that extra cost with this formula. We put in here the numbers of days, 30 days, and you are going to divide by 600. Yes, this 600 is going to be like a constant number. So this means that this is 5%. If you divide 30 days by 600, so yes, you guys improve the cash flow when you are going to pay 30 days later to the supplier, but the trade-off is that the supplier is going to charge the price of the raw material with an extra cost of 5%. So, yes. Yes, this is kind of a, like you are working with his money, with the money of the supplier. So he is saying, okay, if you are going to, if you want to have some credit, this credit is going to cost you through like an interest. The concept depends
the payment supplier. Yes.
Yes. Can you repeat, please?
It depends.
Yes.
Depends the days that we put in the payment terms.
Yes, exactly. I put in the screen 30, so this is going to be like the interest. If I put here 60, this is going to be twice, no? This is going to be with 60, this is going to give you 10%, no? If you replace here by 60, this is going to be 10. The white boxes, the only white boxes are assumptions. Yes. The only one that is going to be important is this one. Yes. Because with this one, you guys are going to be able to understand how many products do you have on inventory. Yes. And this is going to be important in order to calculate the income that you are going to expect to have. For example, sales volume. I'm going to put here a big number. Yes, I'm going to put 500. Yes, I cannot sell 500. I can only sell 56 units. This means that I don't have any inventory of product A. Yes, because if I can produce 56 units and I can sell 56 units, it is because I don't have inventory. Yes. When you have one difference there, the quantities that are the difference are your inventory, okay? The other one, it is only for to make assumptions. Total market size means that all the companies have sold together 300 units. Yes, this is the market size. And the market share is 20%. Why is 20%? Because the 100% of the market, the 300 units, is divided in equal pieces because we have 5 companies per industry, okay? So 100% divide 5 companies. Each company is begin in equal condition with a 20% of market share, okay? Now, I would like to explain that to pay the suppliers later, it is not the only way to look for resources. Yes, you can go to the bank if you don't have enough money for your investment plans. Okay, so I'm not going to go into the detail of product B because it's going to be the same as for product A. What is going to be different? It is corporate. Okay, so I'm going to explain here the decisions that are not at the product level but at the corporate level. So those decisions are especially related with this information. So I was saying, let's begin with the end. That if you need one, you can go and contact the supplier and pay the supplier later. Yes, you are going to have more cash flow. However, you are going to deteriorate your profit because they are going to charge more. But you have other two ways to get funds. One is the short-term debt. Yes. This is very expensive. Yes, when you go to the bank and you are going to ask for a short-term debt, the bank knows that you are in trouble. Yes, and the bank is going to charge you a very high rate, 12%. That's because the bank feels that you are like in a hurry and probably it is not so sure that you can pay back the loan, no? But you can have like a more planned debt, which is the long-term debt. Yeah? And the bank is going to charge you depending on how much debt you have before. Yeah? This is the debt to equity ratio. Debt to equity ratio is one relation that you can calculate dividing. You have here the debt, and you divide that into the equity of the company, which is the value of the company. Okay, so this is going to give you a percentage that is going to be between 0 and between 100. Okay, if you have like all of the value of the company come from the debt, yes, this is going to be 100. So all what you are seeing here in this classroom, the table, the chair, the computer, the video beam, yes. If the Javeriana has bought this through a credit, yes, this is going to be the same value here, the same value here. This is going to give you 100%. Yes? But probably most of the resources come from the like from the from the university, and a little bit of debt was needed. Yes, so this number is going to give you like a very small number. So when you are below 40, like the organization is in a good situation because there is no risk of bankruptcy. The debt is small, so you pay low interest rates. But when you guys are close to or above 80%, you have a bankruptcy risk, no? The situation is going to be under control, probably you are going to be bankrupted, okay? Here, at the corporate level tab, you have this information. Yes, we are talking about the cash flow statement, okay? Cash flow statement, again, the same format, 3 columns. First column, result of period 4, actual result. Second column, forecast period. Yes, this is the number that like you are forecasting. And third column, changes between 4 and 5. Once you guys like are done with the decision, and once we run all the decisions in the simulator, like we are going to have real results for period 5. Okay, that's the dynamic. So here you guys have the decision with the loan. It says long-term loan in, long-term loan repay, and short-term loan in. Okay, so in the previous round, the previous administration asked for a short-term credit, yes, of $450. Okay, it is better to avoid this type of credit, no? Only if you don't have any more alternative. Okay, so let's put here 0 for the next round. Okay, so it's a decrease of 100%. Yes. And the previous administration also got a long-term credit in the previous round of $700. The point is not that the company is only with a $700 debt. This is the debt that they acquired in the last round, but the debt of the company is bigger. Okay. So if you want more debt, yes, you can put here, I don't know, 500. Yes. But let's look the debt to equity ratio here. Yes, so what I explained on the board is here in the graph. You have in dark blue the equity value. Yes. In the other blue, light blue, you have the long-term debt, yes, which is part of here, plus the red one, the short-term debt, yes. So if you guys are going to calculate the ratio, you are receiving the company with a 68% of debt to equity ratio. Okay? So the company is paying this range, 6% of interest. Okay. So look at what I did. I asked again for a long-term debt of $500. So what's going on here is that I am increasing the debt of the company. I am putting the company above 80. So the company is going to pay the maximum rate of interest, yes, because it has a lot of debt. Okay? But you have other options. Yes, probably do not ask for more loan. And probably here this second box that says long-term repaid. Yes, if you repay debt, this debt to equity ratio is going to like to be in better situation, no? Okay. And this one dividend, at the beginning of the game, you guys cannot pay dividends. Because what is the meaning of dividend? It's like the way to distribute the profits of the company with investors, with stockholders. Up to now, the company has not yet given profits. So there are no profits to distribute with investors. If you put here dividend of $1, it's going back to zero because there is no money to distribute, okay? Finally, the other decision at the corporate level, it is this one, related with human resource and quality. Yeah. In the previous round, the company, the managers invested $100 in human resources and quality decision. Now, it is the same amount of money, $100. You take the decision. Should we improve this budget or should take money there? What is the impact of human resources? Let's go to the rules. When you are putting money in that box, what you are doing? You are investing in people and invested in tools like information technology, okay? This is going to have in one of the 6 criteria that are evaluating your performance, which is the employee morale. Yeah? Employee morale, like when the company is investing in human resources, like employees are happier. Okay? This is going to have one impact as well in all the business processes. Yes, like marketing, like research and development, and like production. Money spent in human resources and quality takes one period to be effective. Yes, so it's not going to have an immediate effect, but it's going to, you need to invest today to get the results in the next round. Okay, so it seems that it is important to invest in human resources. Okay. And finally, let's remember that you guys are being evaluated with 6 indicators of performance, which are sales revenue, EBIT, retained earnings, return on capital expenditure, employee morale, and the price of the stock. Okay. Once you guys are done with the decision, yes, you go to this tab, validate tab. Here the simulator make you a summary of what's going on. And here there's a message, like a warning. Your forecast cash at the end cannot be negative. So I cannot click into validate your decision. It is not going, like the simulator, it is not going to allow me. When I click here, I can't. Okay? What is the problem? Or what is the meaning of this warning? That here in the decision tab, at the corporate level, in the cash flow, I am having cash at the end negative, minus 2,807. Okay? This means that my forecast of cash flow, my forecast of my wallet, yes, it is that I'm going to have a shortage of funds in the round. Yes, so I cannot forecast like that because I won't have at some point money to pay employees or to pay suppliers. This value needs to be at least with $1, okay? So probably if it's going negative because two things. One is that for product B, when I am still having here sales volume of B in zero, like the forecast is not calculating the income that product B is generating, okay? So here I'm going to put that, okay, I'm going to sell something about B. So I'm going to be able to sell the 62 units that I'm going to produce. If we go to the corporate button, corporate tab, look that now my cash at the end is still negative, but it is like close to zero, no? It is not with the minus 2,807. Okay. So I need to cut expenses, yes, that are close to that number in order to have my cash at the end positive. So what I'm going to cut, I am not going to repay the $800 of debt. I am only going to repay 400, half. And now I have my cash at the end positive with $71. Yes. So I can go now to validate. And now look, the message is different. Yes, the message it is I'm ready. Yes, and now I can go and validate the decision. Yes. When I'm going to validate, look that I'm going to be able to touch here, and it's going to ask me, are you ready for product A? I click here, are you ready for product B? I click here, and then I click validate your decision. I am done. Okay, I'm ready for seeing the results with the other company.